Have you thought about growing your wealth but don't know how to start? Talk to Invest by Metricon. They make property investing easy. So for all your tomorrows, build your financial future today. Invest by Metricon. Build wealth. Build today.
This is a Momentum Media production.
Welcome to the Smart Property Investment Show, the podcast by investors for investors.
G'day, how you going? Phil Tarrant, host of the Smart Property Investment Show. Hope you're well. Navigating lockdown, no matter where you are. To our international friends who tune in, interested in Australian property, you seem to be tracking a little bit better than what we are at the moment. We're smack bang in the middle of lockdown, and there's a lot of expats, Aussie expats, who are either in the UK, Europe, up in Asia, or over in the US, who have got an eye to the future and maybe thinking about calling Australia home once again. And this is going to be the reverse brain drain we're going to get, I think, once we get vaxxed up and move forward through COVID-19. We're going to be attracting a lot of smart Aussies back to Australia, helping to build and drive forward what's going to be a golden period, I think, for Australia in the Indo-Pacific. But that's getting a bit geopolitical, geostrategic. Let's not go there today. We're talking property, but if you're out there looking at Aussie property from other parts of the world, remember, keep connected, smartpropertyinvestment.com.au, helping you make more informed decisions. But we're locked up. Western Australia seems to be doing all right, but the rest of Australia is locked up, in particular New South Wales and Victoria, as we navigate COVID-19. But guess what? And hasn't put a damper on property markets at all. It's as hot as ever. All the economic commentators and forecasters are still coming out giving all the reasons why Australian property is booming ahead. And this is on the basis of a lot of the usual traditional drivers of property growth in Australia. It doesn't really exist right now. By that I mean migration. However, let's get into it. I want to actually understand the top 5 reasons for the recent Australian housing boom. Will it continue? How long will it continue? And what do you do about it? Outside of my pay grade, but I know someone that knows a few things about this. ARjun Halliwell, Director and Head of Research, InvestorKit, which is a buyer's agency, property strategist. I guess I've explained you pretty well, ARjun. How are you going? What's happening?
Good, my friend. And as you pointed out, the boom is what's happening at the moment.
Why are we booming right now, even though we've got this COVID 2.0? Everyone's working towards this 70% vaccination rate, 80% for opening up and having freedoms. Qantas, I doubled down on Qantas shares the other day. They came out, that horrible financials for 2021, but they're talking about flights starting internationally to Asia and the UK by December. What's going on, mate? Why isn't property slowing down, even though Australia's got its handbrake on at the moment?
We'll talk about baby steps, right? We're in terms of flying interstate, flying overseas, each country open up. It feels like you're just getting that little bit more each time something happens. But property boom, we talked about 5 reasons off the mic. And I think with these 5 reasons here, I can start by the first one, which is pretty clear to the mass majority, and that's low interest rates. Now, the RBA cash rate sits at 0.1%, and I feel like we're overusing the historic low word, Phil, because every single year it's like a new historic low. But what's interesting is it's sometimes very easy to get caught up in our own bubble, no pun intended there, but 26 other countries are at a 0 or a negative interest rate, 3 or 4 in the negative. So we were at mid-2019 at 1%, Phil, when it comes to interest rates, but it's actually the flow-on impact of that, which is households during lockdown as well had a lot more time back to have some more urgency to go, what am I going to do with my finances? I mean, interest rates are low, but am I going to do something about it? And guess what? A lot of people did a lot about it, and that's what sparked the refinance boom into 2020. We saw commentators from, AFG, Australian Financial Group, saw a refinance boom. April had applications spiking to a peak of 38% of total share of applications going into refinance. October, this started to slow down, back down to the 21% to 26% ranges. And then even other places like, Combank's internal data showed more than 45% of its lending occurring at fixed rates. And the New South Wales Land Registry showing a 22% jump in New South Wales for refinancing. So a lot of cheap money is the first reason. And the impact that cheap money had because of the lockdown saw us use that time, increase market competition, cashbacks, refinances, fixed rates, all sorts to get the money flowing and money cheaper.
So a quick sort of economic lesson for our listeners who aren't that familiar with how it all works. So you're talking about low interest rates. You're talking about the official cash rate, which is set by the Reserve Bank of Australia. So this is really the setting that the Reserve Bank, so the sovereign mechanism for controlling money in Australia, to shape the behaviours and habits of Australian consumers. So you talk about 26 are at zero or negative, we're at 0.1. And by 26 is zero or negative, you're talking about Western nations, right? You're not talking about Sudan or Bolivia or somewhere or other. You're talking about Western nations. They've all got really soft or negative official cash rates. So what they're trying to do is get people out there to try and stimulate economic growth, or at least have some sense to sensitivities around buying behaviour. Can you give us some sense? I know you used to work in a bank and stuff, but what does this all mean, Arjun? The fact that if Australia is going, we're going to keep interest rate low, what do they want Australians to do?
Well, essentially, we want less household stress in terms of finances, for greater confidence, for more consumption, spending. Low or lower interest rates are both a good and a bad. They're good for your pocket when you feel as a borrower or a spender, but they're also bad because they're only being done as a way to say that our economy is not producing what we want it to produce. And we're hoping, this is the RBA speaking as the we're hoping that the lower interest rate environment can help see those funds flow back into it. I can't say it's been a very successful strategy when it comes to, moving the economic dial, but when it does come to, maintaining the debt levels that we have and making sure that housing consumption is good and how we feel about our money, that's definitely helped on that front.
Australia's credit rating is pretty good, by the way, globally. And I think Standard & Poor's only recently, probably a month or two ago, said it was pretty good, gave us the thumbs up, which is good. It means Australia can borrow money and stuff. But to your point, so when you look at this period of the COVID-19 crisis, and already the economy was on an upwards trajectory prior to it, property was moving, the government's pretty much gone, you know what, we're going to let property run. We're not going to intervene too much. And they let it run the first time through COVID-19. And I was having a lot of chats with people, Arjun, probably in March, April, May of this year, going, well, it's probably about time that the RBA might actually get involved and start ratcheting the interest rate up, and or there would be some other intervention to try and slow down buying behaviours, primarily from investors inside of property. So they're already seeing these green shoots of rapid growth that they felt like they were going to need to try and control in some way. Then we hit COVID 2.0 and they've just gone, bugger, let it go, let it go, let it go. So the question to ask is, when's the government going to step in and try and curb these sort of sentiments towards money in the market and getting Aussies to go out and buy stuff? Because, inflation is another big part of this equation.
Yeah, so APRA came in recently and provided some guidelines around what they're monitoring. And so the RBA and APRA have an interesting stance. It's kind of like a throwing it around of prices aren't my problem, is the kind of feeling or statement that you get. And it makes sense because one group is looking at lending conditions or lending strength in terms of just making sure standards aren't deteriorating, risky lending. And the other, body is looking at economic activity in which houses play a part, but not prices necessarily. So some of the guidelines that were thrown out were around, consecutive years of double-digit growth. Other things that they're in the watch list are higher or much larger increases in investor lending becoming the majority. So I guess one of them we can say, yes, investor lending's increasing, but owner-occupier lending still the lion's share. And then the second part, which has not happened just yet, but is probably on track to happen, is the 2 years in a row of double-digit growth. Now, these aren't hard measurements that they've said we're just going to go in and stop once these occur, but they're signs that are of importance to them and when it comes to the decision-making by APRA. So one of them is likely to come up. The second and third are TBC for now. But that's the first part, Phil, when it comes to interest rates and that impact. But as I mentioned, there's 5 reasons here for me to go through. One alone isn't the case, because if that was the case, we've been in low interest rate environments and decreasing environments for many years, even pre-COVID. And we didn't really see our Brisbanes, Adelaides and our Perths start to pick up until later in recent times.
One thing you're guaranteed is that rates will go up at a point in time. I'll tell you that now. You might not like to hear that, but guess what? It's going to happen. And you're guaranteed it's going to happen. It's a matter of when it's going to happen. Now, it's sort of part of this economic equation. There's talk that we're going to enter a recession again, 2 quarters of negative growth. Let's see how that happens. We know through COVID, the first round, we came out of that recession pretty quickly. halfway through that second quarter of negative growth, they went, nah, don't worry about it. It's just a on paper recession, the economy's firing ahead. So, again, that's going to play a part of this and what the government chooses to do with interest rates. And now if the government lifts the cash rate, the official cash rate, guess what happens? Banks are going to lift their interest rates as well. So that's when you start getting a kick in terms of increased mortgages each month that you pay. So make sure you've got buffers in place and be setting your borrowing ability and your repayment ability on, I'd be adding a couple of percent to the interest rates you're currently paying, prepare for the future. That way, when it arrives, it's not too much of a shock. Second point here, top 5 reasons for the recent or current Australian housing boom, ARjun: government stimulus and bank moratoriums. Tell us about this, mate.
Yeah, so we had all the fancy names come out, right? Job Seeker, Job Saver, Job Keeper. The marketing campaigns were well and truly there from a government perspective of all of that stuff. Home Builder, Cash Flow Boost, business grants, bank moratoriums. The list goes on of the level of support in those unprecedented times. But Phil, we've got to be honest about where the support went to. And I'm sure those in government who are part of the programs responded swiftly. So I won't go into the politics. That's great. But at the same time, I don't think everyone who needed it, got it. And then the flip side, a lot of people got it when they didn't quite need it. So what this created is it filled pockets for who didn't need it. And obviously it did support many that needed it. And it created new norms for household budgets, which I'll come to soon, but also new norms in the land prices, which is something I know you'll be familiar with from hearing some of the stories on the ground of what's been happening in the new land releases, fights and queues from people trying to get themselves a block of land, builders jacking up prices, land sellers jacking up prices. Essentially, it created new norms on that front. But what that did is the RBA charts clearly showed how sentiment and confidence responded. It definitely was a major, major increase there. Now, sometimes we also think of stimulus as just cash handouts. It's also the impact on infrastructure. So many infrastructure projects were brought forward or focused on and brought to attention, jobs being a very key focus as a result of that. And one of the key data points I like to look at is the Internet Vacancy Index, the IVI. We use that to judge, what activities are occurring on your portals like Seek and other places where we see what we call a negative correlation to unemployment rate. So as the Internet Vacancy Index increases and strengthens, more jobs being advertised, unemployment goes down. And so we've seen many regions really strengthen off the back of that. Your Brisbane's, Adelaide's as an example, but your regional cities by far outperforming the capitals when it comes to the jobs, which sounds funny to many because you think it'd all be in the other places, but the regionals relatively to their own size have increased massively on the jobs. And that's definitely a big reason to put a floor on the damage that could occur, but also boosted a lot of areas as a result of infrastructure, stimulus, and bank moratoriums. Reason number 2, Nate.
Yeah, and so application, do you do much regional buying or are you mainly a city sort of bloke?
Well, I follow my own portfolio. I'm half regionals, half capitals, so I'm doing a lot of both.
Yeah, okay. All right, well, I'll ask you where exactly you're buying in a moment, but we're going to go a quick break. When we come back, more of the top 5 reasons for the recent Australian housing boom. Back in a moment.
In the property investment industry, there's countless stories of the one that got away. And it's always the same reason. To pay the deposit, they needed the settlement from another property to come through, and they waited. Realty Assist Australia knows that when you find the one, waiting isn't an option. That's why they have a same-day settlement fund advance service. There's no credit check, no application fees, just a single one-off fee to advance your equity. Visit realtyassist.com.au/settlements now.
Welcome back, everyone. Phil Tarrant, host of the Smart Property Investment Show, with ARjun Halliwell from InvestorKit. Top 5 reasons for this Australian property boom. Number 3, ARjun. Household savings ratios and the return of expats. There we go. Look, I spoke about that at the start. Everyone's coming back to Australia. Reverse brain drain. It's the place to be.
It is the place to be. And I think you touched on something as well with the expats in terms of the type of people returning, skilled labor. Grattan Institute data was very fascinating to see their review of Australian migrants and typical home buying intentions going back into previous census reviews and so forth. And what it found was a bit of a myth-busting statement here. we often think migrants come into the country and they're out there buying all the houses and migrant money's flowing in immediately. Not the case at all. They typically rent for their first 4 years on average. But I do feel that because we've got a different type of migrant as a larger proportion returning, Aussies who've usually gone away for some sort of employment reason as a large amount, probably went overseas for skilled income or skilled labor or higher incomes as an example, sometimes even lifestyle. But they're returning healthy pockets. And this is anecdotally speaking from many premium sales agents. And by premiums, I'm thinking your eastern suburbs, North Shores, and your other premium markets across the country. And there's a lot of buying pre-migrants coming back into Australia as they use their sort of incomes overseas, funds position overseas, setting up shop for when they come in, as well as those who've just hopped the plane and buying. So that's one key part. But the household savings ratio is an interesting one. When we think of households ratios, there's essentially disposable income and you consume it, you save it. Those are the two real options. Typically, this was hovering from that 4 to 8%, more so in the 6 to 8% mark between 2009 to 2020 of household budgets. And this shot up to 20%. So a lot of people cashed up, whether it be from Aussies not spending overseas, Aussies returning back with cash, stimulus in the pockets of Aussies who now feel a bit more comforted. But that shoot up to 20% in household savings ratio is massive. It has dropped, so we can't say it's going to be there forever. It has to come back to its norms, still above its norms, hovering at 10 to 12%. But that's big reason number 3, Phil.
So why are Aussies saving more money? They can't spend as much?
Yeah, not spending a lot. I remember reading an article out there and I said, that's so us when it came to how much Aussies spend overseas. And my wife and I looked at each other going, yeah, when we go overseas, we're really trying to live it up and enjoy it, right? I mean, as most do when you think of the Balis, the Thailands and everywhere and whatever you're doing for your trips. But spending overseas is big for us. Consumption is fairly big. And of course, when you combine all of that, stopping, being locked up at home, mobility is restricted, fear comes up in times of recession. You're unsure, job stability, what do? You whack in a whole bunch of stimulus funds on top of there. It does call for some extra money.
Yeah, and it's changing. And I think you saw it during the GFC. People started taking a lot more responsibility for their financial future. When people dusted a lot of money on the stock exchange, they went, oh, God. And this COVID-19 has done the same. People are a lot more attuned with their financial health and taking responsibility and accountability for it. So that's the smart way to do it. And that in some way sort of lends itself to point number 4 here, Arjun. The top 5 reasons for the Australian recent property boom is lifestyle changes. People are doing things differently now and they're getting what's now called COVID clarity. It's helped them reassess what they're doing and choosing what really is important to them and what isn't important to them. What are you seeing here?
Speaking of COVID clarity, retirement, that's a word that's popping up in so many people's minds, whether COVID's brought out a lifestyle change or whether it's brought out I'm sick of this crap when it comes to being locked up in a city or being where they are. And I can recall a particular conversation in Hervey Bay. We were there doing on-the-ground due diligence a few months ago, back when the lockdowns went on for us Sydney-siders. And I remember meeting Colin from Ray White out in Hervey Bay, great guy and true Hervey Bay local, been there for the many years. And a casual weekend for him is a dive into the ocean and, catching all sorts of things or seeing all sorts of things. But the amount of people he just spoke to that talk about, I'm over this and I'm bringing forward my retirement plans by 5, 10, 15 years, cash out, sell out, whatever it may be, was huge. And he wasn't the only one saying that. So bringing forward retirement plans was one. The high rise versus low density, being locked up in your apartment building or block. I don't think a lot of people found that fun. Safety. And of course, the problems that you have, which I'm sure you'll get when you turn on the telly any given minute, is the varying COVID rules between states and cities. Super confusing. One state's feeling like a certain way, performance varies. And all of this migration's just been happening and it's been supercharged. But the biggest thing for me, Phil, is that to bust a myth along the way is that regional migration is not new. It's been happening positively from a trend perspective since 2014. Sydney, on the flip side, has had negative migration internally for the last 20 years. Yes, overseas is a huge part. Population size is a huge part. And people leaving Sydney in comparison to its population size isn't anything super game-changing. But the regional shifts are not new, and they've just simply been supercharged with the extra work from home, lifestyle, retirement plans, safety, and varying COVID rules. So
Yeah,
it's for
and
sure
you see that with
the
the migrant community. And we're not talking expats here, we're talking about migrants, so new to Australians. They like to get their training wheels on in the big cities, and then they usually look for other opportunities. They normally arrive either in Sydney, most of them arrive in Sydney or Melbourne, and then they look north towards Brisbane as a nice place, which is a little bit more affordable and lifestyle. So you're going to see that moving forward even more so than what it is right now. One of the challenges, though, inverse of that is trying to get people out into regional Australia. I think people are happy to move to capital city like Brisbane or the Sunshine Coast, but getting people out into regional Australia, Arjun, no doubt you've done a lot of work on this year. And by there, I'm thinking about your Armidales or your Bendigos or your Sheppartons or your Oranges or your Bathursts or, those type of locations. What are you seeing there? Are people moving out there, or are they still struggling getting Aussies and new to Australian migrants out into those regional capitals or regional centres?
Well, in my opinion, they're definitely moving there in a lot stronger force now than ever before. The trend's been positive for many of these locations, Phil, but I think the big X factor now is if anyone wants to have a look at the Internet Vacancy Index data, the job advertisements, the explosion in the lines of your Waggers, your Bendigo, Geelongs, Toowoomba, the job markets in these areas are picking up massively. And so if you think of the three reasons for moving, safety, lifestyle, affordability, and can I get a job there? So there's two components of jobs. One is they're working, they're physical, and the other one is the work from home. So we've seen the work from home explode. Now, it won't stay at the same levels forever, but it will create a new norm. And we're now seeing localized job markets in the region pick up with huge strength, especially with, just the focus from all government levels to go, we need jobs to get this recovery in play, infrastructure, connecting our cities better. All of these things are well in motion and being talked about more than they have before because of the recessionary times and what we've been going through over the last year and a bit. So yeah, the thing is people are moving there, but just remember it's important to note that a 10% jump in some of those smaller cities can be big when it comes to percentages. Volume-wise, it's not always the same. Same with when you see an ABS charts show 20,000, 30,000 people leave a Sydney or Melbourne. It might sound like a lot of people, but we've got to bring back the relativity of percentages and actuals.
Yeah, you said people moving. It's a good point. I think one of the permanent fixtures as a result of COVID is going to be greater appetite of businesses for sort of hybrid working environments. And your job might be in the city, for example. That's where the office HQ is, but you may operate out of regional Australia, and every now and then you pop in the offices and say g'day. I think that there is putting greater jobs or make greater money into the regional economies where people can now, if they're largely white collar workers, can now make a choice about where they want to be doing their work from. That said, I'm seeing it now is that people actually like coming to the office when you're forced to work from home all the time. If that was a permanent fixture, I think a lot of people will struggle with that. So Australia's got to get a feeling for how that balance is going to be moving forward. But it's good news for regional economies, the fact that they can attract, even at a hybrid environment, more people out of the capital cities. The government likes to pump in department-based type offices into regional Australia, tax offices and stuff. They're pretty big in regional areas. That attracts different people to those regional economies, hence the reason why that's got a bit of a sort of step change to regional property markets, which we'll get into. We've got another break. Stay with us. We're going to crack that code when we come back in a moment.
The mark of financial success isn't about getting bigger, better, faster, or more. To Paul, success is freedom. Freedom to spend more time with his family, or giving back to his community, or just more time to go surfing. Paul Glossop, an award-winning property buyer and regular guest on the Smart Property Investment Podcast, has taken the lessons he's learned building a multi-million-dollar property portfolio and laid them out in his best-selling book, A Surfer's Guide to Property Investing. For a limited time, get your free copy of Paul's award-winning book and receive a roadmap for building both lifestyle and wealth through property investing. Grab your free copy today at purepropertyinvestment.com.
Welcome back, everyone. Phil Tarrant for the Smart Property Investment Show with ARjun Halliwell, Director, Head of Research, Investor Kit. Now, Arjun, all this stuff that we've just spoken about, the first 4 of the 5 reasons for this current property boom, and no doubt a lot of these trends will continue, and there's some clues there for how market's going to move into the future as a result of this. We've still got to get a handle on exactly what life after COVID looks like for Australia, but there has been some fundamental shifts. Only a couple of years ago, the Prime Minister came out saying he wants Australia to be a leading digital economy by 2030. And if we're a digital economy, guess what? You can generally do the business of digital anywhere. So that's going to shape how people work and how property markets operate. But right now, it's impossible to find a place, Arjun. Stock levels for rent and sale, bonkers. I haven't seen anything like it. This is point number 5. What's your thoughts here?
Well, firstly, the stock levels, like you said, it's crazy. How low they are is both scary for renters and people who are in need of just the shelter, and also a tough time just for the typical punter trying to buy a property. So firstly, I think it starts with the surge in lending and search intent. So realestate.com.au produces a great search insights report. And what it showed from, your normal search levels from May 20 to April 2021 was an explosion. 30% increases in the for sale searches. So that's the starting point of intent. All right, I'll whack open the laptop, the phone. I'm going to start searching for property. And this actually got to a peak in April of a 90% increase year on year for search activity. It's since then fallen back, but still at very high levels. I'm predicting a round 2 of surge after we have our current restrictions removed. But what this surge in lending and the search intent has done, combining it now with listing hesitancy. Imagine, we're sitting locked up in Sydney. What's making me think I need to sell my property if I don't have to? What's making me think, I'm now going to, cash out on this money if I've got nowhere to go, nowhere to move? Mobility makes this listing really decline. So what that led buyers or investors who've, been caught up in this growth is they've been looking at existing stock. Now, I can assure you from the existing stock that has been moving, many buyers have probably made a lot of poor choices because this sort of stock was sitting there over 180 days on market, over 100 days on market. So essentially taking a lot of time to sell. And even that sort of stuff has declined massively. SQM's research shows a huge trend decline. So that's a key piece. But now structural changes in listings, Phil. What's interesting to see is regional areas have actually had their decline in listings since 2016. So this trend of more and more listings declining has actually been a 5-year-long trend. For capital cities, it's been a 2-year-long trend. So I'm confident that investor inactivity has a key part to play. You can think of, lending restrictions, APRA's changes, bashing the investor when it comes to negative gearing talks. And if the houses aren't being built by the government, they've got to come from somewhere. And that's where investor activity is key for rental stock to come up and for sales stock to come up, because their tenure, how long they hold stuff, is typically lower than how long an owner-occupier may hold something. So this has created a huge variance, Phil, because now we've got this huge 30-40% decline in many cities for active total listings. But where I have seen things change is that when you look at markets like your Brisbane, your Perth, your Canberra, where there's a bit more fluidity, less lockdowns, we are seeing listing levels pick up a little bit there, which does mean that if we all get some mobility back again, listings will pick up. It's just going to have a lot to catch up because the existing stock has been swallowed up.
So what's all this mean? I'm reading and I'm hearing, Arjun, there's another 20% growth this year from some forecasts around Australian property. Get your crystal ball out, mate. What's the go? What's happening? What do you do as a property investor?
Yeah, so stock levels aren't going to change overnight. Lifestyle changes are cemented. Household savings falling down. Government stimulus is declining for sure. It's just not the same. So there will be more people feeling a pinch. But here's my crystal ball. Firstly, controversial here. I reckon interest rates are going to go down again. And I know they can't fall by much, but 0.1, I'm calling a 0% by the end of this calendar year. So hopefully, we can chat about this in the new year, see if this prediction came right or not. But I'll timestamp this. We're chatting the first week of September, Arjun, and you're calling 0% interest rates. All right. Well, I'm not going to offer my commentary on that. That's your call. And if you get it right, you're a genius. If you're wrong, I'll remind you about it. Don't worry about it. I'm calling interest rates at 0 by the end of this calendar year. I'm calling a very strong finish to this year and into the first half of second year. But we will see more mobility. So the lockdown changes and things like that will mean mobility increases. But when mobility increases, Phil, we can see it in trends in Perth, Canberra, Darwin, and Brisbane. Listings will increase. So the growth will just not be at the same pace with such low listings, which is currently hovering at 1.5 to 2% per month, which is ridiculous. Can't sustain that level. But I do see growth rates coming down to a 0.8 to 1.2% heading into 2022. for the first half of the year, which is using a little bit of our metrics and forecasting out. I think the biggest thing that buyers or sellers can look to is what we call our finance data. This is a very broad scale, though. It doesn't come down to your micro market. We can fast forward finance data by 6 months to go, here's applications, and 6 months later, we'd assume a lot of them turn to deals done. And based on that, finance was bonkers in June, July. So we should see some very, very strong finishes towards the tail end of this year, going into the first half of next year. But expect the growth to taper, Phil, as we move from first half to second half of 2022.
So the question to ask then, if the Reserve Bank, and whether or not I subscribe into this point, I don't really have a view on it right now, was to move to a 0% on the official cash rate, do you think the banks would actually move their rates at all? Because that's what really matters.
Yeah, it is. I think what we've already started to see some. And how I can share that is that, each week brokers, which I have one in-house being my wife, which is pretty cool, they're given emails from the banks regularly from their business development managers who are pretty much just hungry to go, hey, take your clients' loans to us and here's some recent updates. Their recent updates already have reduced interest rates by 0.1% on many variable loans. So it's almost as if many are pricing it in already. And the second factor here is that yes, there will be a few that don't. And the reason why is because of funding costs. It takes me back to 2018, 2017, when we saw RBA decrease rates. And you might recall a time where everyone just got pissed off because the banks weren't coming along to the party. Well, all the rate decrease did is really just soak up some of the funding costs from overseas that increased rather than actually bring back any real profitability. So I'm sure that's due to happen based on some factors overseas. But I do feel that some of the pricing is already occurring. The last 3 weeks are a perfect example from the emails many brokers are receiving.
Give me a hotspot. Where are you buying?
Cool. I'll give you one across the few states.
All right, let's do it. Normally you don't, but I thought I'd ask. So
hey, I'm not one of those normally you don't ones. I think you've asked me a fair few, and I've always given you some locations.
All right, tell me what's going on. Houses, not units.
Definitely. So in the New South Wales market, there's no slowdown across the coastal pockets from your Coffs Harbour, Port Macquarie, and your Central Coast. Coffs Harbour and Port Macquarie especially very, very strong. So that's my New South Wales on that front. When it comes to Queensland, I'm going to shout out a few regional pockets, and not because Brisbane's not hot. It is crazy hot right now. And not because Sunshine Coast isn't hot, it is also hot. It's simply just because they've been at it for a good year now for Brisbane and a good 3 years for Sunshine Coast. So I'm giving a shout out to the inner regional city of Toowoomba and the inner regional city of Bundaberg. So expect some movements over there. Adelaide continues its way, but now we've got folks in the Barossa Valley who are likely to look to cash in on some pretty good movements over the next 6 to 12 months based on our data. And if we go over to Victoria, Bendigo, whilst it's had a tremendous growth, the jobs are going crazy, even amongst lockdown, prices aren't tapering off. But we can also add Shepparton to the mix because it still hasn't slowed down either. And it doesn't look like it will any minute soon. That's a few there just to, whack off, only because we're caught up in a hotter area at the moment, Phil. 96% of locations as at my July 30th data ending are in an upward surge. So I could just keep naming places and I probably wouldn't be wrong with 96% going up.
Yeah, there you go. Where do you like in Sydney at the moment?
Sydney, take a look at, outside of the premium markets, just from the typical investor, take a look at the southwest of Sydney. So places from your Campbelltown region are going off within your first open home, above asking. And when I say open home, more like the agent, visiting 1 hour after the open, taking a video on his phone, and he or she's got 6 offers after a couple of hours from putting the ad up. So the southwest of Sydney is definitely.
So anywhere which is a COVID hotspot, pretty much in Sydney, is that what you're saying?
Yeah, pretty much.
the ARjun COVID index.
Yeah, now what's happening, Phil, is that the agents have a reason to not have this perfectly crafted campaign that goes through an open and a whole week or 2 weeks.
How you finding the agents at the moment? Because they love buyers agents when there's no one buying, and they despise you when everyone's buying. They ain't got time of day for you. They answering your calls, responding to your emails.
Look, it helps that I've been doing this a couple of years now. And so there's always going to be those contacts that just are there for you. But I won't lie and say that agents don't really need us right now. So they're able to get through what they need to get through. One thing I will throw out there though, Phil, where we're coming in very, very handy is a lot of sales agents are getting a huge amount of objections to one particular thing that vendors keep telling them. And that's, I've got nowhere to go, so I don't care how much you can get me. And so where we're coming in hot is agents are going, Arjun, you look after investors. Investors want rent. We'll rent back. No marketing fees, off market. And so that's a happy median we're finding more than ever.
So you're saying that they'll sell the property, stay in it until they find their own home?
100%.
Yeah,
so
that makes sense.
We solution find during these times.
So on that basis, if someone sells to a property investor, they don't need to worry about bridging finance largely. It means they don't have to buy somewhere before they sell somewhere. Yeah, that makes sense for people in that sort of owner-occupier type stuff. If you're able to transition owner-occupier to investment stock, and if you're talking about the southwest suburbs of Sydney or even western suburbs of Sydney, horses for courses, right? Owner-occupier is always good investment stock. 4-bedroom houses out in those sort of mortgage belts work well. Yeah, that sort of makes sense. And I guess that's probably not a bad, if you are a buyer, as a tactical way to buy effectively. If you say to an owner-occupier and they're looking for another joint, saying, I'll buy the place and you can, I'll give you a discount of rent till you find yourself a new home, you might be able to get a cheaper price on it versus another owner-occupier that wants to move in straight away. So that's good negotiation.
Speed, tactics, and one last little thing, indexing, where you can factor in the growth between just last month and last week and now. Those are the 3 biggest tips for people trying to buy in the tough times of buying right now.
It's absolutely berserk now. It's all the whole idea of missed opportunities cost. If you don't buy that place, you buy something in 2 weeks' time, it's going to be a different price point. How crazy is it? Like, I know some people sit there, there's calculators out there right now that'll tell you how much wealthier you are today versus what you were yesterday purely because of your property.
Well, I mean, in terms of what I like to do to balance out the craziness with just trying to stay a bit more measured is we apply an indexed growth rate of 1% to 2% because that's what's naturally happening. So if we've got a 600K property in June, we're now in August or September, I'm going to say that property would resell again for 612,000, no questions asked. So that means I can't look at a comparable sale of today, which is tough because data has lagged, right, with sale properties and settlement times and listing times. But if you see a 600K property from 2 months ago and you think it's similar to yours, you've got to add 12 to 24K just based on what's moved.
Wow. Okay. Well, you made me feel wealthier, Arjun.
Paper wealth, Phil. You can't go and...
No, can't do anything with it. No, don't worry. I'm still eating baked beans and Maggi noodles. That's all I can afford, Arjun.
Well, it looks like you weren't part of that refinance boom then, right? Did you not save a whole bunch of cash on that part?
No, I just called up all the banks and said, give me a cheaper rate.
There you go.
Yeah, I'll do that in time. I've got to do it. I'm about to go through a process of doing a whole bunch of refinancing. I chat about the smart property investment portfolio quite a lot. I did all the hard work and got frustrated by it, just calling up all the banks. And I was able to reset a lot of our stuff to like high 2s or very low 3s.
You're missing out on the Dysons, Phil. You're missing out on the cashbacks, the Qantas gift cards. You've got to get on that.
I don't need any of that stuff. It's just all noise. You got to keep your eye on the prize. But I am going to refinance some of the stuff. I'm about to start that process now in the smart property investment portfolio. It's with one of the major lenders, and the major lenders obviously keep their rates a lot higher. It's a bit of a cartel, right? Like, the 4 major banks, 5 if you want to include St. George and co, they'll keep their prices high, whereas your mid-tier banks are a lot more open to negotiation. Your Suncorps and your Bankwest and even Macquarie get some pretty sharp rates off those guys just by negotiating. But strap in, you got to spend the time. If you're happy sitting on hold to banks, you can actually shave a few percentage points. Are you buying at the moment, Arjun? What are you up to?
I'm literally in the middle of getting my pre-approvals. So the next 6 months is definitely buying time for me. Maybe we should catch up again in the new year to see where it's all at.
Mate, let's do that, Arjun. I'd enjoy that. Thanks for your time today. 5 top reasons for the recent Australian housing boom. And it's going to continue to the middle of next year. Is that your call?
That's my call.
Okay. All right. Well, we'll reassess that and see how you're going. I don't have an opinion on this. I'm just a journalist. I'm not supposed to have opinions, Arjun, but it's Arjun Halliwell from InvestorKit. Thanks for your time today. Remember, smartpropertyinvestment.com.au, social media, Smart Property HQ, if that's how you like to get your info. Make sure you subscribe. There's some pretty cool reports on Smart Property Investment at the moment as well, regional reports where we go deep dive into stuff go to the website. You can track it down there. We'll see you again next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.
In the property investment industry, there's countless stories of the one that got away. And it's always the same reason. To pay the deposit, they needed the settlement from another property to come through, and they waited. Realty Assist Australia knows that when you find the one, waiting isn't an option. That's why they have a same-day settlement fund advance service. There's no credit check, no application fees, just a single one-off fee to advance your equity. Visit realtyassist.com.au/settlements now.